Accounting for private and not-for-profit entities, and this is covering everything except for hospitals, which is covered in a separate presentation. So for this presentation, we're only focusing on charities. All right, the general characteristics of a not-for-profit organization. They receive contributions from donors who do not expect a return of equal financial value. Their operating purpose is not providing goods and services for profit, and they do not have ownership interest as do for-profit organizations. FASB has jurisdiction over private not-for-profits, and two basic ideas form the FASB framework for not-for-profit standards. The financial statement should focus on the entity as a whole. Reporting requirements for not-for-profits should be similar to business entities unless there are critical differences in the needs of the users. Those are the guidelines. So, they have to report assets, liabilities, and net assets. They use the term net assets rather than owner's equity or fund balance. Net assets are presented in three categories: unrestricted, temporarily restricted, and permanently restricted. Now, this has changed, and the change will become effective December 15th, 2017. And instead of the three categories, they now have said we only need two categories, which are net assets with donor restrictions and net assets without donor restrictions. However, ASC 958 allows that the donor restricted assets be further broken down between those in perpetuity and those that will be spent over time, which means we're back to the original three categories. And in the book for the homework, they require that you use the three categories. However, for the quiz, you should remember that there are only two categories starting in December 15th, 2017, which is donor restricted and without donor restrictions. All right, here are the requirements for items to be categorized. If it's temporarily restricted, it's for a particular purpose or for use in a future time period. An example would be they donate money specifically for helping people that lost their homes in a hurricane. Another would be it's limited to a scholarship fund, or it's limited to buying books for the library. Permanent restricted, expected to remain restricted for as long as the organization exists. In this case, an example might be if they donate a painting, or another example would be is they donate money and tell them they can only spend the interest. And unrestricted allows the board to use it for whatever they want. So, cash is recorded as revenue in the period received. Conditional promises to give are recognized as revenue when the conditions are met. Restricted gifts are not the same as conditional gifts. Unconditional promises to give are recognized as revenue when the promise is made. Pledges that allow donors to change their mind are not unconditional, which means you wouldn't record them until you got the cash. So here is our example. During the current year, a donor gives $400,000 cash to a school, but requires that the funds be held forever. However, any investment money can be used for staff salaries. During the year, the investment made $31,000, and of that amount, $20,000 would be spent. So for the current year, what are the changes to the unrestricted net assets? There would be no effect because we didn't have any. Okay, what is the effect on the temporary restricted net assets? Well, these would have changed because we earned $31,000. That is temporary restricted, but we spent it on $20,000 in scholarships, so we have a balance of $11,000. And what is the effect on the restricted net assets? Again, increased. B, 400,000. So we're still at 400,000. Hasn't changed. Now, if we were to look at this under the new rules, we would end up with 411,000 in donor restricted, because we would have combined the increase of 11,000 with the 400,000. So just so you know what the new rule means. Okay, donor 2. A donor gives a machine to the school on January 1st. It has a fair market value of 200,000, no salvage value, and a 10-year life. The school is required to keep and use it for 10 years. For the current year, what are the changes to the unrestricted net assets? No effect, because these are not unrestricted. What is the effect on the temporarily restricted net asset? Well, in this case, it increased by 200,000. However, we had to reduce it by 20 for depreciation, so now it has gone down to 180,000. What is the effect on operating expenses? It increases by 20,000 for depreciation expense. Okay, a donor gives 400,000 in cash for student financial aid. The school charged $2 million for tuition and granted 700,000 in financial aid. The donor's gift offset 300,000 of the financial aid for the current year. So in this case, when we look at this, we know that we have 400,000 in temporarily restricted cash. So what are the changes to the unrestricted net assets? Increases by 1.6 million, because what we did was we charged 2 million in tuition. We granted 700,000 in financial aid, and we had to reduce it by 300,000 because of the financial aid we received. So we had an increase of 1.6 million. What is the effect on operating expenses? There's no effect if this is revenue. And what is the effect on temporarily restricted funds? They decreased by 300,000. Now, under the new rule, it would only be donor restricted decrease of 300,000. And that ends this presentation. Thank you.